US stock market crash in April. Hey everyone, Business Society welcomes you back with yet another great video. Today's video will tell you about a possible stock market crash in April. Keep watching the video so you won't miss out on the news regarding the anticipated market crash. Before we begin, don't forget to smash the subscribe button and the notification bell icon to get the regular notification on the new upload. Here we begin. Canadian and US stocks and global equities are trading near record highs and just had their best November ever. Investors are increasingly optimistic following word that COVID-19 vaccines will be available soon, that Joe Biden won the US presidential election win, and that his administration will provide not just political stability, but will also provide additional stimulus that will keep the stock market on its bullish trend. But that optimism may be unfounded, with Harry Dent suggesting the stock market will crash 40% by April 2021 and won't rebound for decades. If we see another new low in the stock market, I predict we're not going to see new highs on the Dow, S&P, Nasdaq, Biotech, you pick anything. You're not going to see new highs on anything for decades, Dent said. You didn't see new highs after 1929 for 24 years. The economic recovery has run its course, and the equities market will soon realize this, Dent said. There's a lot that's not going to come back. I think we've hit the V-shaped recovery for 80% of the economy that did not get permanently damaged. But there's this other 15 to 20% that's not coming back, he said. Consumer spending will also remain weak as the baby boomers enter their retirement years. The millennial generation will drive us up from 2023 forward, but not until then. So still weakness in demographics, massive debt. I say we don't ever fully recover from this, and by early next year, we realize that, he said. The next stock market crash will not simply rebound like the sell-off of March 2020, Dent added. It's a reset for the greatest financial bubble in history, partially caused by a good economy at first, like the Roaring '20s, but greatly goosed up central banks, he said. The trigger for this crash is more bankruptcies, Dent noted. This COVID thing hit early this year. I give that a 9 to 12 month lag before you really feel the small businesses and zombie companies fail. They don't go down overnight. Stocks can go down overnight like they did, but bankruptcies and Chapter 7s and 11s take time. I think by the first quarter you're going to see more companies going under, and that's going to be the trigger, he said. Why might there be a crash? Although day trading and momentum chasing seem to be ruling the roost in the first few weeks of the new year, it's operating earnings growth that drives equity valuations sustainably higher over the long run. That's why it's always important to pay attention to market-based fundamentals no matter what's going on. The figure that should have investors pretty concerned is the Shiller price-to-earnings (PE) ratio for the S&P 500. This differs from the standard P/E ratio in that it's based on average inflation-adjusted earnings from the previous 10 years, as opposed to just earnings from a single year. Looking back 150 years, the S&P 500 has averaged a Shiller P/E of 16.78. Admittedly, the Shiller P/E ratio has been a lot higher over the past 25 years. The advent of the internet has broken down information barriers for retail investors, and historically low lending rates for more than a decade have fueled borrowing and lit a fire under growth stocks. But as of Feb the 3rd, the Shiller P/E for the S&P 500 was knocking on the door of 35, more than double the long-term average. To put this figure into some context, there have only been 5 periods in history where the Shiller P/E ratio topped 30 and stayed there during a bull market run. 2 of these events, the Great Depression and dot-com bubble, led to some of the biggest pullbacks ever witnessed in equities. 2 other events, not counting the current move, occurred within the past 3 years, delivering declines of 20 and 34% respectively in the S&P 500. In other words, anytime the Shiller P/E ratio crosses above and sustains 30 in a bull market rally, it's eventually resulted in a minimum decline of 20%. It's not just stretched valuations that are of concern at the moment. Nosebleed premiums baked into the stock market assume that the COVID-19 pandemic will soon be a thing of the past. This may not prove to be the case. As an example, take a gander at the latest COVID-19 vaccine survey results from Kaiser Family Foundation, KFF. In mid-January, KFF asked respondents about their willingness to receive at least one dose of a COVID-19 vaccine for free. Some 6% were already vaccinated, with another 41% willing to get it as soon as they could. Meanwhile, nearly a third, 31% of respondents were in wait-and-see mode, while a combined 20% either definitely not getting it or getting it only if required. Note, figures don't add to 100% due to rounding. That's pretty much half of the population that's unwilling to get in line for a COVID-19 vaccine right now. According to recent comments from Dr. Anthony Fauci, it would take between 70 and 85% vaccination rates to achieve herd immunity. In other words, the pandemic could be far from over. To build on this point, many working Americans and their families are counting on continued assistance from the federal government. Millions of workers have been laid off or furloughed, and some of those who are still working have seen their hours cut. If partisan bickering continues on Capitol Hill and additional fiscal stimulus is delayed, it could have serious negative consequences on consumption. That's the leading driver of US gross domestic product, and might lead to a substantial increase in loan and credit delinquencies. That would be bad news for financial stocks, which many consider to be the backbone of the US equity markets. So, there seems to be a high possibility of a market crash in April. With this, I'm concluding the video. I hope you enjoyed watching. Make sure you subscribe to Business Society, and if you're looking forward to knowing more about what you should do when the market crashes, then stay tuned for more videos and news like this.